how does any of these deals sell in 3 or 5 years? What is the exit cap rate? How much money are you actually going to get when you sell? The two things that need to happen are you need to increase net operating income, and then the question is, what cap rate are you applying when you sell?
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures. From multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of Alternative Investor Mastermind. I'm actually shooting from our new podcast studio, which is up and running. We shot some great content here with a engineer to do proper audio video. This was supposed to be a Zoom podcast, but going to shoot a couple solos in here as well. So normally we've got this nice microphone set up and we've got some stuff in the back. Don't know how to use it all by myself here. So, in future episodes, we're going to have everything dialed in, and we're going to have a lot of live interviews as well. Being based here in San Juan, Puerto Rico, there's a ton of interesting investors, lots of opportunities, a lot of people doing a lot of interesting things. So pretty excited about it because, just going to be a lot of great content, a lot of great conversations to be had here. So in the meantime, just wanted to shoot a quick solo podcast here. And one of the hot topics that keeps coming up is real estate still overvalued? Really depends on the market. Depends on the part of the country, location, geography, asset class, whether multifamily, office, industrial. It really does depend. But I will talk about a couple of the key asset classes that we see that we're actively investing in. Multifamily is a big part of our portfolio, and the assets that are trading in multifamily are, in some cases down 10, 15, 20, 25% from the peak. If there's something severely distressed, for example, just the operator could not execute. There's a property we're looking at right now that's, occupancy is in the 50s. Just because of a combination of pushing vacancies for renovations, failing to renovate on time, and also just issues with screening tenants. So there's a few that we're looking at that are absolute disasters, and those may sell 30, 40% below where they sold at the peak. But overall, I think an asset that's actually stabilized and fulfilling its business plan might trade 10, 15% below the peak, maybe a little bit more. But the key is, successful operators don't have to sell right now. Operators with the foresight to have fixed rate debt for, a period of 5 to 7 years, are sitting on 3% interest rates and have reaped the benefits of, increased rents across the board. So, lessons learned are to, be with operators that have the staying power to get through what's been an unprecedented hike in the short-term interest rates. So there's a lot of questions about when to jump in, when not to jump in. Investors are afraid of catching the falling knife. What I could say to that is we're continuing to be active across the cycles. We were active in 2020. We had the benefit of some amazing run-ups from 2020 into 2021. A number of our deals, we doubled our money, had 40% IRR. So, we had a benefit of catching the upswing. And, now going forward, the deals that have been done this year, are being purchased from those motivated sellers, those sellers that missed the peak and need to sell either because of an issue with their debt, or in some cases, it's just a life event. One of the properties was actually a family, and the patriarch had passed away. And, there's a number of heirs, and they just wanted to sell. So it was a timing thing. They were selling into, not the strongest market. So, and now, a latest deal we had a call on today was a pretty well-known seller that's, made some of the industry newspapers of their struggles. And, they're selling this asset to, salvage, to raise some money to try to salvage some of the other assets. So this one, there wasn't anything particularly wrong with an asset. However, the seller was motivated. So there are good deals out there right now. My gut says that we are very much, past the peak of interest rates, that rates will come down, and that's going to be good for real estate in general, and that there's a lot of liquidity out there. So I don't see any, at least I don't foresee any falling knife scenario. And I think we're towards the bottom of real estate prices. And for us, I mean, my best advice is to, stay active and dollar cost average into deals. Some following up on that, just some recent updates. I mentioned earlier that the strong sponsors are, persevering and making it through. So we're in over 40 deals, but of the older deals, there's about 30 deals that were, bought in, that we then made some investment in between 2020 and early 2022. And, a strong sponsor has proactively negotiated a number of modifications. Now, these modifications give us interest rate relief for the next 2 years, and also, resolve certain covenants around debt service coverage. The lender does not want the properties back. They trust that that us and our partners are the strongest group to actually take the property across the finish line and let us get through our business plan, and not force a sale when rates are probably at their peak. So that's overall good news. In some cases, one deal last quarter did require a capital call. We invested about 30% additional to our initial investment in the property, but as part of that was part of the terms of the modification. So the bank wanted to know that we had interest reserves, that we had capital, we had enough of our own skin in the game. And for that, we got significant interest rate relief for the next few years and the ability to finish our business plan. Other side of the story is a group where we're looking at a possible acquisition from them right now. And that group failed on their operational plan, had a high vacancy rate, was not executing properly, and was really just imploding from the inside. That group attempted to make a capital call on one of the properties. However, they failed to raise enough money because the investors were just not confident in their ability to execute. And now that property is, in pretty deep trouble. There may be, a rescue plan. We're actually, in addition to the managing, of our own funds, because of my capital markets background, I actually consult for a few funds and family offices to source opportunities, since we see a lot of deal flow. So this and a number of assets are coming our way where, we're aware of sponsors that are in trouble. And sometimes it's a potential buyer who has has an inside track to buy an asset, and then they come to us, with a property either under contract or close, and they're looking for, since these deals need to close very quickly, especially if the bank is willing to take a haircut, they generally look for larger check writers and more institutional partners. So it's something I'm seeing more and more of right now, and it's a pretty exciting time. I've been to a number of industry conferences recently, and again, no one has a crystal ball to know exactly what's happening with with interest rates and the debt. But one of the terms I kept hearing was survive till 25. The Fed has indicated that there will likely be rate cuts this year. With that, so as I record this, the CPI came out yesterday, and it was a little hotter, a little higher. It was, I think, at 3.1 instead of 2 point something. So maybe that pushes the interest rate drops a little longer. And then we obviously have an election cycle coming up. So nobody knows for sure, but the prevailing wisdom is that rates will subside at some point this year. And what's important to note is it's not just the Fed's rate. The Fed's rate currently is between 5.25 or so. The 10-year is also very, very important, and the 10-year does not always move with what the Fed's guidance is. There's sometimes a question of is the tail wagging the dog? Does the bond market push the Fed, or does the Fed push the bond market? The 10-year pushed all the way to 5 in the fall, and that created havoc in the capital markets. It really froze them for a period of time. And then within a few months, it dropped under 4, and it ticked up a little bit the last few days. So the 10-year is really more important than the Fed, in my opinion, because the 10-year is what long-term buyers are usually locking in at, and that's what historically is tied to cap rates. So when you're looking at how does any of these deals sell in 3 or 5 years, what is the exit cap rate? How much money are you actually going to get when you sell? The two things that need to happen are you need to increase net operating income, and then the question is, what cap rate are you applying when you sell? So if the 10-year does subside at some point, that's going to be very good for real estate. Pretty exciting times over the next couple of weeks. I am actually heading out to a conference in Phoenix. There's going to be a lot of real estate syndicators. We're also going to be taking a bus tour to tour various properties in Phoenix, and I'm already personally invested in a deal or two in Phoenix as well. So a lot of property tours, going to be attending a conference, number of one-on-one meetings with current investors, active property manager syndicators. So it's going to be a busy time. And just realized I'm actually going to head to Vegas after that as well. There's an actual institutional conference that I used to go to religiously at my prior company that I owned, that has a lot of more institutional investors, bond buyers. There's people that do mortgage-backed securities, as well as a lot of funds and operators. So I got a few meetings set up there already, and it's going to be an exciting, interesting time. Catch up with some old friends from Wall Street from back in the day, and should get a lot of interesting color on how they're going to attack the real estate market this year. So pretty exciting times. Overall, my take is that, real estate is, not significantly overvalued, and that there's great deals to be had right now. And that, if you're really trying to time the market to the day, it's nearly impossible. I think you just have to be on the lookout for good opportunities. If you've been on the sidelines for the last year or two, I believe that, now is the time to get active. And, active may mean just diving in to make sure you're seeing as much deal flow as possible. It doesn't mean invest in the first deal you see, but there's a lot of interesting opportunities. So hopefully, you're those of you listening, hopefully on our mailing list. If you're not, because you might just be a podcast listener and are not familiar with JKAM, definitely get on our mailing list as well, and as well as others. I think the first step is seeing deal flow and understanding the deal flow, so that when you see a deal that makes sense, and you know better because you can compare it to the other deals you've seen. So that's about it for this episode. Please, if you're watching this on YouTube, please like and subscribe. If you're on iTunes or Spotify and you like what you're hearing, please leave us a review. It helps. And please reach out with any questions you have as well. Hit us up on all major social media. We're on Facebook, LinkedIn, Instagram, TikTok, and would love to hear your questions. So that's about it. We'll see you in the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.